US President Ronald Reagan called it as deadly as a hitman. Nobel Prize-winning economist Milton Friedman called it taxation without legislation. And yet, inflation has not been on the agenda, has not been front of mind for advisors, research houses, or indeed the media for quite some time. With that in mind, IFA assembled some industry stakeholders to discuss a roundtable on inflation risk and the impact that this risk has on financial planning and on clients. Take a look. I welcome you all to this meeting of minds, and I thank you for your attendance this morning. So before we kind of get down into the nuts and bolts of asset allocation philosophies and sort of the client-facing side of this, I thought we might just take a step back and look at the macro scene for a moment. And if Jonathan, you wouldn't mind kicking off, how is inflation trending sort of broadly, and how much of an issue is this looking forward?
On the face of it, there aren't very many inflationary pressures, certainly in developed economies. And part of that is a sort of residual from the financial crisis, and the fact that unemployment rates remain pretty elevated. And CPI numbers in a lot of developed markets still look pretty benign. But we are in a period where interest rate and monetary policy has moved into sort of uncharted territory, with ultra low interest rates, not just in the US, but you're seeing it in Europe, and you've seen the Japanese follow with that type of strategy. And historically, there hasn't been a period where you've seen this ultra low interest rate policy not followed by a resurgence of inflation. And I think that is something that people just need to be wary of. I think we've almost produced a generation of investors who have got used to inflation being pretty benign. But if you go back and talk to people who were investing in the 70s and 80s when inflation levels were much higher, the impact that has on your returns, your real returns, so that's after inflation, and the impact that it has on your real purchasing power is quite significant. And we just need to make sure that our clients, almost whatever age group they're in, but particularly those people who are moving into retirement or are in retirement, understand the sort of impact that inflation can have on their savings.
Jonathan Ramsey, I know Van Eyck follows this issue quite closely. Do you agree that it's only a matter of time?
Look, we'd break it more down into a scenario-based view of the world, and I think Jonathan's absolutely right that if you start looking at the numbers, it's very clear that because of those things, inflation, or especially stagflation, is the thing that's least priced into markets. So people look at real-life scenarios, and they look at the 70s, or from a deflationary point of view, Japan or the 30s. And I guess the thing that's easy for people to miss when they're just reading the papers and sort of applying their own insight is you've got to look at what markets have priced in. And in the past, a deflationary scenario probably would have been more damaging. However, the modelling we've done, we've got a specific model that on our sort of online portal, which actually allows people just to change inflation assumptions, because we think it's that important. And one of the really interesting things about that is that the deflationary scenarios, looking forward in real terms, are the ones that hurt you less. So that's a sustained period of below 1% inflation, that turns into some kind of a spiral. And actually, balanced portfolios, conservative portfolios especially, don't do that badly. But it's because inflation is not priced into markets. It's probably still a low probability scenario, but it's the one that holds the highest risk, because it's not the one that people are expecting, and it's the one that will hit asset prices, especially fixed income, to the greatest degree. So therefore, and people aren't used to thinking in probability weighted terms.
Before we sort of look at the response to that risk, if indeed it exists in that way, to those of you who work on the client-facing side, do you kind of agree with what these gentlemen have said in terms of the risk that exists? And also, is this something that is on the mind of clients?
Definitely, it is on the mind of some clients. For our younger clients, they're not really aware of it. They haven't lived through a period of inflation. And so for them, it's an education process. we like to use the words of Ronald Reagan, after we explain to them who Ronald Reagan was. He said inflation is as violent as a mugger, it's as frightening as an armed robber, and it's as deadly as a hitman. That sort of makes them take stock and think, well, what is this inflation? And that sort of is our entry point to explaining to those guys how it can really erode, as Jonathan said, your purchasing power. For our older clients, our much, much older clients, they've lived through numerous periods of inflation. So we're talking about the 70s. But if you go back to the 50s, we had 24% inflation back in the 50s, and they've lived through that as younger teens and younger people. Through the 70s and the 80s, inflation of 6 to 10%, which over that period was pretty consistent. And then in the early 90s again, we peaked up at about 6%. So for those people, it's more of a reminder of hark back to when you lived through this during the 70s or the 80s. How did that feel, and what did you do to sort of mitigate that? So for that, it's either an education process or a reminder process for our clients.
Jamie, are you also seeing this same sort of dichotomy in terms of the demographics of your clients?
Certainly, I agree, Tim. For younger clients, they have no experience of just what inflation really means. They've got nothing to compare it against. And I use my own example. The sort of the first investment that I ever had was a very thankful gift of $2,000 from my grandma back in 1989, and I had that in a one-year term deposit with the Commonwealth Bank, and it was 13.5%. Well, it sounds great, but inflation was running at 1989 at roughly 10%. So I use that personal example with those younger clients just to help them to understand that just that real return versus that outright result, particularly when it comes to yield, is so important to take into account. Older clients, spot on again, Tim. I totally agree. As soon as you mention inflation, all of those Reagan-type comments around how frightening it can be really come home to them, and they start talking about when their mortgage rates were at 19%, etc., and how difficult that was. I think the other comment I'd make just on clients and the education process, and it comes back to something you mentioned as well, Jonathan, is giving clients a sense of how an inflationary impact changes their long-term outcomes. So when it comes to the actual day-to-day cash flow management and modelling for clients, we tend to give them examples. Scenario one, best guess of long-term inflation. Now let's ratchet up by 1%. Let's put it up by 2% per annum and just see what a difference that has in terms of how long your capital lasts, the taxation outcomes as well. And that really, I guess, from an education and impact point of view, drives it home.
So Andrew, you're very involved in portfolio construction in your group. Is this something that really only affects people who are looking to retire, or do you have, as Jamie was outlining, two different approaches?
No, I think it applies for everyone, and we factor that in. I think it comes, I agree with Tim about that education piece of saying to clients, it's yes, the whole classic, what are we wanting to achieve goal-wise, but also factoring in that when we do model and construct portfolios for clients, we also have to factor in covering our fees, but also inflation as well. And I find that's a big discussion I'm having a lot more with my retired clients about saying that the last 5 years everyone's had an instinct of to just sit in cash, but having to explain to them that long term that's not sufficient to keep ahead of inflation. And that's where I've been able to educate and help a lot of my older clients be comfortable with the fact that they need some equity exposure or some property exposure in their portfolios, because they understand that's what will enable them to beat inflation.
Just open it to kind of everyone. Is that really one of the main keys of going after a strategy that is mitigating inflation risk? Is it moving away from cash?
I don't think it's not about moving away from cash. I think it's about having perhaps a more flexible approach to portfolio construction and asset allocation. And it's also realising that we are in an unusual set of circumstances, certainly in developed markets, around in terms of what monetary policy is. There is a pretty significant experiment going on which hasn't been tried before, and we don't know what the outcome is going to be. And you've seen perhaps an early skirmish of how markets might react in terms of the recent debate about tapering. There was a pretty significant move in bond markets around the world, and actually nothing's happened. you've had some people talk about something that might happen in the future, but there's been no change in short rates. But that sort of follow-through impact was pretty significant, and I think part of the reason for looking at this issue is just to bring into the debate that perhaps static asset allocation policies are not the right answers for a number of clients. For some, they certainly will be, but for others, depending on their circumstances and also where they are in terms of the sort of retirement cycle, that sort of rigidity that you've had in asset allocation is just actually inappropriate, and a more flexible approach to asset allocation can actually take advantage of some of the sort of gyrations that you see in markets to benefit clients.
So you're talking about outcomes-based financial
Yes.
planning? Okay. And what about the others here? How do you is that something that you employ, or is it different for each client?
From our perspective, it's different for each client. Again, if the client is aware of that and has an understanding, then that's an easy discussion to have. But for a lot of clients, I think your earlier point about cash, a lot of them still are in that mindset of the defensive nature of their term deposits and being a large percentage of their portfolio because of the uncertainty, and they were giving adequate yields. Well, they were, and so for them, it's a mind shift away from it being one of the best things they had in their portfolio in recent years to potentially being one of the worst things over the longer term. So having that discussion with them and just making sure that they're aware that those risks to cash, holding cash over the longer term, are significant.
There's this idea that things will just sort of plateau. So again, we go back to scenarios, and I think you have to get clients to understand what's going on, because you're going to make decisions and they might not always be the right one. So we're at a stage where I think we do have to be dynamic, but we somehow have to involve clients so they internalize the decision, because there is no right policy portfolio that can deal with a deflationary and inflationary scenario. So at some point you have to make a choice. So we've got used to this sort of all-weather idea that a balanced portfolio will, you leave it long enough in there and you'll do okay. There's a stable risk premium. So one, I think you have to talk about the ability to make decisions and people understand why you took them, so that if it doesn't go that way, you say, well, look, that's the risk that we took off the table. That's why we did it. They should understand. And then you have to look at diversification in a different way. And that means putting other things in there which are more resilient in both scenarios. So alternatives, and that's a big catch-all admittedly, would be a larger part of portfolios for us. Things that can adjust but are not necessarily so binomial in their response.
Jamie, how do you work out which of your clients is appropriate for that sort of an approach?
As Tim said, it's a client-by-client individual philosophy that we have, and I guess as an overlay, and it's a good point about the requirement or need to be less rigid and have greater flexibility in asset allocation. It's a really difficult one. The way we deal with it is to run what we call goals-based investing. So to move away from the classic, here's the pie chart with the sectors, etc., of various asset classes, but to take into account the goals that the client have and break those down into the must-haves, the absolute essentials that are non-negotiable, right through to completely aspirational goals that, if that works, that's blue sky and wonderful, but over here I can still get the kids through school. And that helps drive part of the asset allocation decision and helps, I think, with getting clients to really think about what their true risk profile is. So rather than risk from the point of view of a particular asset class having a bad outcome for a period of time, the real risk from a human point of view is not how much money I've got in the bank, but can I do and can I complete those lifetime goals that I've set for myself and my family? That's the approach we typically take.
It's a question for these guys. So just before you leave that one, in all of that, do you think risk profiling maybe has less of a part to play or doesn't really address that question?
Really good point. I think traditional risk profiling, and I'll be relatively controversial here, I think has not kept pace, unfortunately, with compliance right through to FOFA.
Yeah.
It's a real problem. Having flexibility from an advisor's point of view at asset allocation level is incredibly difficult. Because to have a client that fills out a questionnaire and has a result that says they're highly conservative, that outcome from an asset allocation point of view might be a disaster for them in terms of their life's goals and what they're wanting to achieve. So yeah, difficult, really difficult.
I'd agree with that. What I'd say is, if risk profiling is put in some multiple choice questions and you get the answer right, that is a real risk. For us, risk profiling is brilliant in that it helps us understand the clients better. It's one tool that we use to determine what their correct asset allocation, their approach to risk and return is. And it's a useful one because if you're doing a wife and a husband, you'll see internal conflicts between them, or you'll see internal conflicts between their own thought processes. So from our perspective, it is a very, very useful tool. Is it the answer? No.
So it needs decoupled from the compliance process.
Yes. Yeah. And I think a big part for us is that we see that fundamental problem with static risk profiling, in that we look at a growth investor in 2008 to a growth investor today. There's times where you want to be in the market and you want to be out of the market. So we've developed what we call a risk on and a risk off allocation for each of those traditional risk groups. So it talks about then being dynamic and being able to change throughout wherever we are in the cycle or markets. That when we think things are getting risky, we take risk off the table, and that for us is a big way of having clients understand that this needs to be dynamic, and there is the day of set and forget is just well and truly over, in our opinion.
So you mentioned compliance there. Everyone was kind of in agreement that this is an issue. What could be done from a legislative or regulatory point of view to help foster this approach?
You need to build it, make it more nuanced and complex, and something that sits between the planner and the client, because the most compliant portfolio, people are on the conservative side. So if you're trying to be really compliant, really cautious, you might bring the client down. And the most compliant portfolio out there is 70% in fixed income and has no chance over 3 to 5 years of achieving a CPI plus 2%, for instance, objective. So there's an internal conflict in there which says the compliance process is making people do things which financially just don't make sense. There's an internal contradiction. So you need to, I would leave it to these guys more, but when we're working with planners, we're talking about time horizons, expected returns, getting people involved at that level, and what are realistic income requirements. People don't really have, they've got an idea from a few years ago when income levels were here, and then they try and maintain that, and they're putting risk into other parts of the portfolio inadvertently. So we think a much more structured conversation about what these investments are going to deliver realistically, so they can internalize that a little bit. And I think it's the process that planners go through, but they can't be hamstrung by a compliance process that pushes them in the wrong direction.
It's one of my personal bugbears. I'm tired of our industry turning to legislative solutions. The government, we're the experts in this area. We're a profession. We need to set our own standards rather than relying on the government of the day or the whims of the government of the day to set that. So I'd say it's more our profession as financial advisors coming up with some of those standards and accepted standards internally, and then adhering to those.
Jonathan, I know you've done some research on how behavioural finance fits into this discussion. How much of this is about managing expectations from a financial planner?
There's a certain amount of that. I think that there are, one of the things that has emerged in the last sort of 4 or 5 years is that a view that post the financial crisis, people's aversion to loss has changed quite dramatically. That's perhaps not surprisingly, but it definitely impacts behaviour, and depending on where your age and where you are in terms of coming up to retirement or actually in retirement, quite understandably, your sort of past experience drives your future expectations, and that has had a very profound impact on the way that people invest. And there's certainly been some work done in the US that suggests that people's aversion to loss has probably gone up 5 times post the financial crisis than pre, and people's ability to stomach losses will very much depend on where they start. If you started investing in, say, the early 80s or even the early 90s, you had a period of very strong returns before any significant sort of change in that pattern. if you started investing in 2006, your experience is completely different. You had a couple of years of perhaps not even that, a relatively benign market, followed by the worst downdraft in capital markets since the Depression, and that inevitably drives client behaviour, and it's incumbent on those people who produce products, but also the people who are advising to help guide people through that. And it works both ways. Not only the aversion to loss, but it can aversion to risk as well. And there's an education that all of us in the financial services industry need to take our sort of clients through. And I think you mentioned the point in terms of the right times to add risk and the right times to take risk off the table, and it's helping guide clients through that sort of process.
How is that aversion to loss? I saw there are lots of nods of approval. I think everyone seems to agree that there has been a change in terms of the way that clients are thinking. How do you approach that as a client-facing advisor?
I think one thing we've noticed though is there's an appetite from clients of understanding that they have to be involved in the process and want to learn. And I use an analogy with my clients saying that let's treat you like your own business. You're both the CEOs telling us the strategic direction, where are we wanting to head, but my role is to act as your personal CFO. I'm there as your chief financial officer. I'm the one there explaining to you what your risks are. And we have a big discussion with our clients on 2 points. You talked about, beliefs and emotions, stem from what education and experiences they've had in the past. And getting them to understand that, yes, what you've experienced in the past is going to cloud your judgment. But if we can throw that out on the table and have that conversation, we can start talking about all the things we're talking about with the clients about, essentially, what are your goals, but what level of risk do you have to take to achieve those goals, as opposed to traditional risk profiling, which is you're person X, so therefore you're this risk profile. And I'm finding, particularly with a lot of my retired clients, the conversations I'm having with them now is not that this fits within your risk profile. It comes down to, do you have to take this risk?
Yeah.
You're now can you? And classic example, I had a client this morning, and we were talking about other strategies of what we're doing with some other clients to reduce risk. But in his position, we said, well, you're very, very comfortable. We don't have to worry about that. You don't need to take those extra risks that we might employ in some other clients' portfolios when it comes to managing their risk. So it's very much about, what's relevant to you, the individual.
The experience, both of the client and the advisor, and you mentioned that, Jonathan, is really important as well. We've got some young planners in our firm who, until very recently, literally hadn't seen positive returns in clients' portfolios. You sort of think about that, and so if that's the mindset or that's the experience of the advisor, when they come to talking to clients about portfolios, they're going to have something of a jaundiced opinion of just what's possible and what real long-term outcomes can be. But ultimately, Andrew, you're spot on. I agree again that it comes back to the client's goals, and in some cases, where traditional risk profiling, I think, fails, if you don't move beyond that traditional approach, then where's the conversation with the client that says, this is where you are now, here are all of the things you want to achieve to get here, now how can we get from A to B with the least roadblocks or the least potential hurdles and issues along the way? I think that sometimes we see people that have portfolios that are vastly too risky overall, and there's just not a lot of justification for why that's required to get them through life and through all of the things they're trying to achieve. And then I think potentially, and I've spoken to advisors who post the GFC have probably dialed back clients' portfolios at the standard risk profile level, dare I say, more out of their own fears than out of being driven by real client needs.
And the irony there is that the market is now paying you more paying you about the same amount for taking on that risk. Meanwhile, the expected return from the stuff that's not going to lose you a lot of money is rapidly lower. So again, as always, you should be doing the opposite.
That's right.
I think, look, here's a thought for everyone, and tell me whether it's realistic. I have a sort of conviction that every person that chooses not to just give the manager an absolute return objective, and all balanced funds ultimately have some kind of absolute return objective, and leave it for 10 years or whatever the time horizon is. If they want to engage, they have to have a basic understanding at a simple level of Gordon growth or dividend discount model. You get dividends, you get growth, and inflation affects it somehow. And if you can have that conversation, then I think that's how you start the engagement process. You know, the dividends are there for a reason. You know, you've got to understand what yield is. And if you're not willing to get into that, then all you're taking from us is promises. And maybe you have to go into something a little bit more mechanized, a lifestyle strategy or something like that. But is that an area where you can? Is that a level that you can start at with?
I think if I tried to introduce models to my clients, most of their eyes would glaze over. But your point is well made in that they're aware of dividends and they know they go up. I think that's over time, and historically have done so. So I take your point there. I think that's completely valid. But if you start to get too complex,
You don't call it dividend discount model, but you just say there's these things and they grow, and this is what we base our advice on.
Yeah, if my doctor started throwing technical stuff, I just my eyes glaze over as well. I just need the prescription. Harking back to Andrew's point earlier about clients not taking any more risks than they need to, I think that's a very good one, and that's very much part of our focus. I think especially for our older clients who are in retirement or moving into retirement, their key concerns are their health, their family, and then third is actually inflation. They're worried. They don't put it in the terms of inflation, but they say, I'm worried that I'm going to be able to afford the things that I need to be able to afford. And funnily enough, health is one of the key drivers of inflation. So that's the sort of discussion we have with those. They are aware of inflation, although they don't call it that. So it just harks back to, well, how much risk do they need to take to get that lifetime goal that they've agreed upon, we've agreed upon.
Just bringing it back specifically to inflation risk, for those of our readers who will be looking at this and they really want to go about implementing a strategy for some of their clients that is about mitigating inflation risk, what are some of the main asset allocation strategies that you'd be recommending in the broad currently?
That understanding and acceptance, again, I think of people understanding that shares and property still does make a fundamental part of the mix, whereas I find many people who are particularly retired, their friends who aren't getting advice are all in cash. And so they're coming to us and saying, well, all my friends are all in cash, why am I still in equities? And it's having to have that, or property and having that explanation, well, this is still part of our yes, the longer term portfolio construction, but it's so we can keep ahead of inflation. And I think I'd say it's more the people who aren't getting the advice, who I'm finding a lot of those newer clients who I'm engaging now, who haven't had advice over the last 3 or 4 years, they're the ones 100% still in cash. And the only thing that's now prompting them to actually seek advice is the fact that they're realising now, well, 3% on my cash isn't that great.
Or your fixed income.
Or your fixed income.
The whole range. I mean, clearly property is attractive in an inflationary environment. You can renegotiate your rents on an ongoing basis, so you can drive up your returns. Plus, if it's leveraged, then the debt that you've got against it, you're paying it off with cheaper dollars. So that sort of it twofold. On the equity side, it's a bit of a mixed bag. If there's unexpected inflation, equities can actually sort of go backwards. So it's not a panacea for inflation. Although over the longer term, companies' earnings, hopefully, as their costs go up, they can put their income up over time. So there's that. Clearly on the bond side, there's a massive risk for fixed bonds, for fixed interest bonds, for floating rate and for inflation linked. Clearly are an attractive solution for some clients. We have had some clients ask for inflation linked products. I think they're a bit ahead of the curve, and perhaps I think over time we'll probably see more demand for those.
That's interesting about the current environment that we're in is the duration risk that people have within their investment portfolios, particularly people who may be doing sort of stuff for themselves, in terms of people who have bought, they've probably got some fixed income, but it's plain vanilla stuff. They're invested in a handful of stocks, probably defensive things or banks, which have been very much the beneficiary of lower interest rates. And they probably own not only just their residential home, but they probably own some REITs as well because they've been producing good yields. But all those investments have been, the capital appreciation has been driven in the last 2 or 3 years by low interest rates. And I think that there's a bit of a health warning in all this, is that a professional investor might call that duration risk. You just need to explain to clients that actually a lot of the things that have been helping their investment portfolios have actually been, it's not been diversity, it's actually been the same thing.
Yeah.
And that there is a genuine risk that if you see it's just normalization, it's not interest rates going up a lot, it's moving back to a more normal period. That adjustment process in capital markets could be pretty painful. And it's helping people to understand that, and there's a little bit of an education exercise in that. But I think that those risks are much more heightened than a lot of people really understand.
And we get very hung up on how we categorize inflation. I mean, we were wrong-footed in the 70s because it materialized in a way that people didn't expect, and you had bad inflation. You want to get techie about it. Phillips curve wasn't as upward sloping as, and then we got used to the idea that it was upward sloping again. You had good inflation, and it led to, there was positive economic growth, and you got more inflation. So the things that I think you have to think around is, what really is inflation? You've got the CPI number that everyone thinks, that is the answer. It's different people, it's different things. And the thing that could wrong foot us this way is asset price inflation. It doesn't really get reflected in CPI to some extent, but that could be the thing that the sort of cost push inflation that really wrong foots us. And
it's a really important comment, and again, it'll depend on the age cohort that you're in. That certain inflation benefits certain types of savers and workers, but if you're in retirement, inflation around healthcare is extremely important, and your ability to sort of keep your sort of real savings, keeping up to speed with that, becomes one of the sort of key drivers to your sort of portfolio returns. And again, it's sort of tailoring the outcomes to, as you said, there is good and bad inflation, and it's just making sure that sort of portfolios are flexible enough to be able to sort of deal with that, and also produce the outcomes that people, the clients require.
Thanks very much, all of you, for attending. I think it's been a very fruitful discussion. From what came up earlier in the chat, I think the media has played a pretty large role in perhaps not putting this on the agenda enough, so we'll take blame for part of that anyway and hope to rectify it. And this is all part of doing that. So thank you all for attending, and perhaps we'll see you for the next one.